So you're here, you spot what looks like the perfect candlestick formation and you think that's it, it's time to buy. You then enter the trade but then still get stopped out. But why is this? Most traders don't realize that using candlestick formations on their own don't mean much. Yes, they are an important concept in trading, but without any context, they are useless. If you are not combining candlestick formations with other concepts such as supply and demand, liquidity, market structure, market inefficiency, then you're going to struggle to actually be profitable in the long run. Trading just candlestick patterns is not a strategy. In this video, I'm going to break down the exact steps I use and then show you how to apply them so next time you know exactly what candlestick formation you're looking at, you understand exactly why it matters, and then you also understand how to make a decision based on that formation. So we are now going to break down the actual 7 candlestick formations which matter. And I'm also going to show you how to combine this with other concepts so you can build daily high probability trade setups. So the first candlestick formation we are looking at is a bullish hammer candlestick. A bullish hammer candlestick is a reversal candlestick which appears at the end of a downtrend. It has a small body at the top and a large wick below representing the rejection. But one key note is a random bullish hammer candle appearing in the middle of the market means nothing. It is only relevant once we sweep a level of liquidity and mitigate it into a higher time frame level of demand. And then we will see that strong rejection to that zone confirming a trade entry. So here I am on TradingView with a pre-marked chart. As you can see, we're in a bullish uptrend as the market is making higher highs, higher lows, higher highs, higher lows, and higher highs. And actually what we can see is recently we've had a bullish hammer candlestick form and a huge push up from there, creating the most recent higher high. So what you can do is map up the high and low of that bullish hammer candlestick and use it as a demand zone to actually take a trade. So what you can see is if I just set up a long entry at this level of demand with my stop loss just below the higher low, because another keynote is once a low takes out a high, theoretically speaking, that low is now strong and the market should not close below it. So this higher low is a strong low, so we'll put our stops below it to protect our capital. And we'll simply just look at targeting the most recent higher high, which is just at this level. So now if I play price, you will see price come back into that demand zone, mitigate into it, and then target our next higher high. And we would have banked 3R on that setup. So as you can see, combining market structure with supply and demand, and then combining that with our candlestick formation can give us a very nice high probability trade setup. The next one is a bearish hammer candlestick. It's the same principles, just upside down. As you can see with a bearish hammer candlestick, it is a reversal candlestick which appears at the end of an uptrend. It has a small body at the bottom and a large wick above, which is representing that rejection. Again, all of these candlestick formations I'm showing you today are just visual representations of a rejection to your zone. So you can use these away from your higher time frame markups. And again, the keynote is a random bearish hammer candle appearing in the middle of the market means nothing. It is only relevant once we see price sweep a level of liquidity and then mitigate into a higher time frame level of supply. And then we see that actual bearish hammer candlestick form representing that rejection, which is giving us the confirmation to look for the sells. The next one is a bullish or a bearish pin bar. So as you can see with a bearish pin bar, we have the long tail with a small body close at the bottom. And then with the bullish pin bar, we have another long tail, so a huge wick representing the rejection with a bullish. And as you can see with the bullish pin bar, we have another long tail. We have that large wick representing that rejection with a small body close above. And the keynote is these pin bars actually signal a rejection to your zone, and they're best used after a sweep of liquidity into your higher time frame zone. And if you're looking at longs, your long lower wick will be at demand. And if you're looking at shorts, the long upper wick will be at the supply. So again, this is nothing too complex. It's just another visual representation of price rejecting one of your zones. So the next one we are looking at is the bullish engulfing candle. So as you can see on the left here, we have a bearish candle. We have the close at the bottom and the open at the top. And then the next candlestick, we have a bullish engulfing candle, because this candle has closed above the previous candle open. So we've closed above the bearish candles open. And then what we can also see, the bullish candle opens at or below the previous close of the bearish candle. And then what you can see is you have this gap lower and a huge push up, which is actually representing that rejection to your zone. And as you can see, the length of the bullish candle engulfs the previous bearish candle. So you can see that we actually open below the actual previous bearish candle and then we close above it also. So I'm just going to show you a quick example of a bullish engulfing candle. I can't show an example for every single candlestick as we will be here all day. But what you do need to do is go onto your charts and study these formations yourself and practice executing away from your higher time frame zones. So as you can see, we have just mitigated into a level of demand. So therefore, we're going to be interested in longs. We are in an uptrend. The market is making higher highs, higher lows, and higher highs. And what we can see here is we actually have the current candlestick is a bearish candlestick. So we'll mark up the highs and lows of this candlestick. So as you can see, I have now marked up the highs and lows of the bearish candlestick. And as you can see, once we play price, the next candlestick actually opens below the previous bearish candlestick. And then as you can see, it has a strong rejection up, and we have this bullish engulfing candle as we actually close above the previous open of the bearish candlestick. So you can see that we've actually now engulfed that previous candlestick, which is actually clearly representing a strong rejection to this demand zone. So we could use that as a confirmation to enter buys and target the previous higher high. And as you can see, if you was to take a buy after that confirmation, if we just play price, you'd get tapped into the trade and your take profit would be hit and you would achieve almost 3R on that setup. But I don't trade without using the lower time frame. So I'd actually drop onto the lower time frame and get further confirmation rather than just jumping in based off the candle formation rejection. But I only execute on the lower time frame. So once I seen this bullish engulfing candle, I would then drop onto my lower time frame and actually look for a lower time frame execution model. If we just take a closer look, what we see is price has paused at this level of demand, created a bearish candlestick as it's waiting for price to actually have that momentum injected into the market. And then once we see that volume hit the market, we actually see the bullish candlestick form below the open. So now moving on to the next formation, it is the same principles as the bullish engulfing candle, it's just upside down. We're now looking at a bearish engulfing candle. So what we see on the left here, we have the open of this bullish candle, we see it push up, we then close here, and then we have this gap up, and from here we have the bearish candle opens at or above the previous candle's close. So what we can see is this bearish candle has actually opened above the previous bullish candle closure, and then from there we see the rejection to the zone as we have a large impulsive move onto the downside, and the bearish candle actually then closes below the previous candlestick open, and the length of the bearish candle engulfs the previous bullish candle. So as you can see, the whole length of this bearish candle engulfs the whole length of this bullish candle, making it a bearish engulfing candle. And the keynote for this one is you're looking for bullish engulfing candlesticks away from your demand zones, and then you're looking for bearish engulfing candlesticks away from your supply zones. And they're best used after we see a purge of liquidity and a price displacement, creating a fair value gap for us to trade away from. The next candlestick formations we're looking at are inside/outside bars. So the inside bar will start off, the technical term for it is an inside bar in Forex is a 2-candle pattern signaling a pause in market momentum, where the entire second candle, the inside bar, fits within the high and low of the range of the first candlestick, being the mother bar. So this is the mother bar, and then this is the inside bar candle, which sits within that first candlestick. It indicates consolidation and often precedes a breakout move, representing a short-term standoff between buyers and sellers. So what that inside bar is representing is a slight pause in the market before it breaks out either onto the upside or onto the downside. And obviously you combine that with market structure and supply and demand to obviously be able to dictate that bias. And your keynote for the inside bar is compression before expansion. They work at levels, not in the middle of a range. So we're looking to trade the breakout in direction of the higher time frame. And now looking at the outside bar, it's pretty similar to the inside bar, but it's just the opposite way around. So the outside bar in Forex is a 2-candle price action pattern where the current candle, so this candle, completely engulfs the previous candle, so this bearish candle. The current candle's high is higher and its low is lower than the previous candle, signaling a sudden increase in volatility and a likely shift in market direction or strong momentum. So it is basically just signaling that there's been a large amount of volume being put into the market and there's been a rejection to your zone, so you can now look to actually look at shorts. And basically what this is representing is that there's been a large amount of momentum injected into the market, so there's been a strong rejection to your zone and you can now look at entering a trade. Moving on to the next one, this is a common one, also known as the doji candlestick. We have 3 examples here: the gravestone doji, where we have the open and close price at the bottom of the wick. We have the long leg doji, where the open and close price is within the middle of the wick, and we have the dragonfly doji, where the open and close price is within at the top of the wick. And again, these are just visual rejections to your zones, and they are only meaningful at levels of supply and demand or higher time frame levels of inefficiencies. And we avoid trading dojis alone. We always wait for the follow through after that, because you're going to see plenty of dojis on your time frame, so don't be confused when you do. Only actually pay attention to them when you actually mitigate into a higher time frame point of interest. And again, it's nothing too complicated. These wicks are just representing a large rejection to a specific area. So if we head on to a trading view, we'll look at this Euro US dollar example. We are in a bullish market. we can clearly see we have Asia range lows and Asia range highs being accumulated. And what we can see is price has just swept Asia range lows. So we've just swept a ton of time-based liquidity, and we've now mitigated into a higher time frame fair value gap, and that is a bullish fair value gap. So we could now be expecting longs to continue with the overall market direction. And what we can also see, we've had a doji candlestick form at this fair value gap. As you can see, we've had a strong rejection. We have the small body candle closure within the middle, which is a long leg doji. And then from there, what we can do is, since we've got the reaction to our fair value gap, we've got a rejection, we can now jump onto the lower time frame and actually look for a lower time frame entry model to present. So I could, for example, wait for the momentum. For example, here we see momentum now injected into the market after we've seen that doji candle form. And then now I could just mark up the most recent fair value gap in the market. And now I can just mark up the most recent 5-minute fair value gap created and take my entry to actually join the momentum which is currently present in the market and target just the previous high with our stop loss just outside the zone. And as you can see, if we play price, this would achieve us a total of 3% on our funded account. So very simple methodology, very consistent, and this is the aim of the game. You want to be getting yourself small consistent wins. You don't want to be always aiming for huge wins in the markets. Building up and scaling up steadily is the way. You want to aim for a minimum of 2 to 3 R being returned on your trade setups, and this is how you stack real consistency and actually stack real consistent payouts. So using this methodology of combining supply and demand, market structure and liquidity with candlestick formations is going to help you achieve high probability trade setups on a daily basis and actually keep you consistent in the long run. So now the final actual formation we're looking at is a breaker candle, the displacement bar. So what we see here, we have a bullish uptrend here, and we have this demand zone created down below, and then what we see is price rejects and we get a strong impulsive move onto the downside where we actually break this order block and cause a breaker block, and then it also creates a huge displacement. We have this huge fair value gap, as you can see, to use as a point of interest, and this big body displacement that creates the fair value gap is an engine for ICT style entries. And what we can clearly see is just a large amount of volume being injected into the market, taking out that demand, which is showing us that the order flow has shifted also. So we could now potentially be looking at sells within this area. So we've just ran through plenty of candlestick formations and how you can use them combined with supply and demand and market structure. But to wrap it all up, I'm actually going to go onto a live chart and actually break it all down so you can see it step by step and use this yourself. And one thing I do recommend after watching this video is going onto your own charts and begin actually studying these candlestick formations and learning how to combine them with supply and demand, market structure and liquidity yourself, so you can really program this strategy into your mind. So I'm now going to show you exactly what I do step by step so you can follow this process and begin getting consistent payouts on your prop firm account. So step 1, we are currently identifying the market's current direction, whether that's in an uptrend or a downtrend. And what we can clearly see on this chart is we are clearly in an uptrend as the market is creating a series of higher highs, higher lows and higher highs. From there, my next job is to identify my current trading range, so I'm aware of what perimeters I'm trading in. So to identify this trading range, all we need to do is mark up the most recent break of structure onto the upside. So as you can see, we have this higher high form here, we then pull back, create a low, and from this low we get a large expansion onto the upside where we form the most recent higher high, given as a break of structure on the left. So I've now marked up the break of structure, which will now allow me to mark up my current trading range, which would be from this higher low to this higher high. Because one key note is with market structure, this higher low was not confirmed a higher low until we invalidated this previous higher high and formed this higher high. And now I have identified my trading range, I can now see that I am in discount pricing as we have recently had a move into demand, and we've moved past the 50% of the trading range, and we are now aware we are in discount, so therefore longs are more high probability, and we've actually mitigated into the optimal trading entry of this trading range, as you can see, into the 0.705/0.79% of the Fibonacci retracement. And then also combining liquidity into this, all of these wicks, as you can see here, all represent liquidity. So as you can see, we've just swept a ton of liquidity going into demand, which is going to fuel the move we are actually anticipating. So far we've marked up our market structure, we've then identified our current trading range, we've then marked up the most recently created demand zone, and now we can see price is currently reacting to this zone. And again, if you've watched the last video, you'll know that we only trade specific trading sessions, and I only trade the London or the New York trading sessions. So I will now wait for price to head into London, as this is where I execute most of my trades, as this is where the most amount of volume is being put into the market for the day, and I like to trade with the volume. And also we take into the liquidity concepts of we have the Asia range lows and Asia range highs. And when we are looking at a classical buy day, ideally what we like to see is the Asia range lows being swept first, with our Asia range highs being left as a magnet to actually target the opposing end of that liquidity. And what we can see on this specific day is we actually sweep Asia range lows first, mitigating into demand, and then we start to see a strong rejection from that demand zone once we swept that level of liquidity, and we now have Asia range highs acting as a magnet drawing price to that level of liquidity. So we now have a clear logical reason for price to move on to the upside, and we've had multiple confluences to suggest this. So now my only job is to perform a lower time frame execution, and what we see is once we sweep Asia range lows, as you can see, I'll just mark that up here, that's the Asia range lows being swept. We have Asia range highs left above to target. So we can see Asia lows have now been swept, and what we see is we actually get a large amount of volume being put into the market as we get this 5-minute bullish engulfing candle, which engulfs above the previous bearish candle, signaling a strong rejection. So we're now using the candlestick formation combined with supply and demand and liquidity to give us further confluence to this trade entry. And what we see is the 5-minute actually gave, and once we got that strong rejection, we actually got a market structure shift, which has now gave us the heads up to enter our trade. So now we've had the bullish engulfing candle, we've had a strong rejection from our higher time frame level of demand, we swept Asia lows, we've got a clear target and a logical reason for price to head to that target. Our only job is to enter. So this is where I would look to enter from. It would just be from the newly created price displacement, this fair value gap. Here's the trade setup. This is a very high probability trade setup. As you can see, we've done top-down analysis and we've used multiple lower time frame confluences to confirm this, and we've also used the candlestick formation to actually further confirm the rejection to our current zone and to actually signal that the volume has been injected into the market. So our only job now is to obviously play price and see how the trade goes. As you can see, we get a lovely reaction to that fair value gap, and price heads straight to Asia highs, as that will be acting as a magnet drawing price to that level of liquidity. And as you can see, we would bank a nice 4.3R on this trade setup. So this was a very simple and effective way to actually gain 4% on our funded account. And obviously, if you are trading a 6-figure account, you're going to make $4,000 within the space of an hour on this setup. So as you can see, it's very simple and very effective for your prop firm accounts. And you always want to be ensuring that you are risking no more than 1% per trade. I actually recommend risking 0.5 to 1% per trade. And when you do actually hit nice trades, instead of sizing up, size down, as this is going to keep you consistent and profitable in the long run. And make sure to avoid these mistakes. Do not just trade the candlestick formations randomly at certain points. So for example, in the middle of a trading range, if you see some sort of rejection like this, for example, and then just try and target a higher time frame and go long, as you can see, if we play price, you're going to hit your stop loss because you're trading within the middle of the range and not actually adding the other elements to the strategy by combining it with supply and demand, market structure, etc., etc. So one key note is to not just use these candlestick formations alone. So please do not trade these candlestick formations alone, as they simply will not work on their own. You need to combine it with supply and demand, liquidity, and market structure, and this is going to help you build high probability trade setups on a daily basis. As you can see, you don't need 37 plus chart patterns. You need context plus these 7. Keep it boring, repeatable, and your equity curve will show it. And if you did find value in this video, then make sure to subscribe. Here at Goat Funded Trader, we focus on delivering real practical trading education with no hype or no shortcuts.